If we're right on the power law trend, then by the end of this year, we'd expect $160,000. The important thing is that the power law index has been stable for a decade now.
The amazing thing about the power law is that it's not a model you're trying to superimpose on top of Bitcoin, right? It's just an observation of what it's done over time.
And it had this nature from the beginning because of the way it was designed. It's created from energy and math and game theory. And you just don't find that in finance. NVIDIA is a good example. It had 10 years where it grew at a compound rate of 69%. It's really physically impossible for it to do that the next decade, because if it did that, it would grow from 500 trillion market cap, and that's half of all global wealth. So that's not going to happen. With power laws, you have a much longer runway, and we see many power laws in nature that extend over many, many orders of magnitude. Nature loves power laws, and fortunately for all of us who are in it.
Hello, everyone, and welcome back to the Bitcoin News Channel. I'm your host, Rob Wallace, and today I'm very grateful to be joined by Stephen Perrenod, a Harvard-trained astrophysicist and associate director of the Scientific Bitcoin Institute. Stephen, how are you doing today?
Oh, great, Rob. Thanks for having me on. Appreciate it.
Yes, absolutely. I think what you bring to the Bitcoin space is completely unique and is unlike anything else. So let's dive into it. First, I want to get into your background. Give me the earliest context of your life that helps us understand the work you do in Bitcoin today.
The work I do in Bitcoin, well, I guess, I started out in astronomy, astrophysics. I decided at age 5 that I wanted to be in astronomy. But relevant to money, I was a coin collector when I was a kid. So, slightly older, but, before the age of 10, I could go to the bank at that time and take a few dollars and get change, wrapped in rolls or whatever. And I would get silver coins for those. And those coins would be, some of them would be from the 19th century at that time. So sometimes I would find barber quarters and barber dimes, but, I collected silver coins as a kid. And actually, when I was in high school, I worked in a bank, and even in college, I was a bank teller. So I had a little bit of touch points with finance and the financial industry from there. But I went on and pursued astronomy and astrophysics, and I did that for several years. Went through to my PhD and then had a couple of postdocs. And as I was approaching age 30, it was a rather unstable field because this was after the big boom from the space race. And we're getting into the late 1970s now, and the funding was dropping. The kind of academic positions were a little harder to get and less desirable, and I decided to make the switch. And so I went into industry, and I ended up in supercomputing. And my first job was doing, software development in reservoir modeling for an oil company. But then I transferred into really the sales side and the hardware side of the supercomputer industry. And I pursued that. I was in there for 3 decades. It was a great career.
Wonderful. And going back to your childhood with the silver coins, did you know anything about hard money at the time? Or was it just the oldness of the coins that attracted you?
We just assumed hard money in the sense that, we even had some gold coins a little bit in the family, although those were already selling at a premium since, the ban had been in place domestically since 1933. But you could own coins as collectibles. And so there was a little bit of that. But no, we just felt that we had this touch point with silver, at least. And inflation, in the early 60s, inflation was low. And it was only later, really with the Vietnam War and late 60s and then into the 70s, that it kind of started to run away. And obviously, once you got into the oil crises that hit a couple of times. At that time, you had savings technology. And they were basically, you would buy savings bonds. You'd buy government savings bonds, and you wouldn't lose money because you'd get paid slightly more than what the inflation was, and they were tax deferred. So you could just kind of put those on a shelf, for later use down the road. And if you wanted to save bags of silver coins, you could do that too, you know. So there were ways that were rather simple to save money. Real estate was not, you know, like it is in more recent decades. It was just something that you got, for the most part, just you bought a house to live in. That all went away. You know, after 1971, savings technology essentially got obsoleted, and everybody had to, over time, realize that they had to be a miniature hedge fund, you know, or an investment manager.
Yeah, absolutely. So yeah, everybody has two jobs now. You got to earn money, and then you got to learn how to invest your money. It's, but then also looking into your physics background. I mean, it takes a unique mind to go into astrophysics, of course. What made that click for you, and when did you realize that was your goal for the first 30 years of your life?
Well, I don't know. It's just the fascination with the stars and that everything was out there, and that there was a lot more out there than there was here ultimately. And I don't know, I just had my mindset on it. And then as I got older, I realized that you had to learn a lot of physics in order to support that it really, there's an observational side, there's a theoretical side, but the other thing that developed was the computational side. So both the computational simulation side and the theoretical side are math heavy and physics heavy. And I ended up doing a thesis that combines the theoretical work with the simulation work, the computational work, in order to try to explain observations that were pretty thin. We did not have that many observations of X-ray clusters of galaxies at that time, and we have a lot more now.
Very cool. So then how do you take that academic background and now use it with Bitcoin?
Well, we're trying to, and we've established the Scientific Bitcoin Institute. I'm the associate director. Giovanni Santostasi and I are co-founders, and he's the director, and he is the discoverer of this power law relationship. I had been trying to model Bitcoin with kind of more typical techniques. I mean, I'd looked at stock to flow. I tried to modify that into something that would be more like the valuation you would have with a gold mine that had a lifetime and so forth, and produce a more conservative model. In technical terms, we say that that would be an integral model rather than differential. And that was too conservative. And, some other attempts at modeling. And I came onto the power law towards the end of 2019, not directly from Giovanni, but from a post that I saw from H.C. Berger. And that just sort of clicked for me. Look, I think with training in physics and being in that field, you're naturally very curious, and you just want to know and you want to understand. And you've learned how to think about things in a certain way, and also how to be thorough and to keep probing and pushing. And then you have some tools, some computational tools. What's been able to accelerate the work has been the past couple of years of AI, because until a couple of years ago, I wasn't coding again. I didn't do any coding for a quarter of a century. Mm-hmm. And I've only, restarted because I never looked at Python. I was a Fortran programmer and some other languages, and I could read the code, but I didn't know where to find all the libraries, and I didn't know about the formatting. And all of that mechanics is taken care of now by ChatGPT or some other AIs. And that allows me to pursue the side that I do understand, which is how to build models and how to analyze them and how to see if they're statistically valid and so forth.
Mm-hmm. And so you first found out about Bitcoin in 2014, but you got convinced of it in 2017 and then started your real research in 2019, right?
Well, I was trying to do research of other sort prior to that. I really started investigating it, around the time that I became introduced to it in 2014 and 2015. But it was kind of more traditional analysis like you would do, like somebody that's in a position as a technical analyst or marketing analyst. I'm a partner in Orion X, which is a boutique Silicon Valley-based technology and consulting firm. And we look at really all of the frontier disciplines that are related to computing technology and so forth. We have backgrounds in supercomputing, and I've been tracking AI since the 1980s at some level. I haven't practiced in that field, but we look at that. We look at technology related to space. We look at quantum computing technology, and we support clients who can be startups or very large companies with projects and with their competitive positioning and marketing and so forth. And so I was approaching it more from that sort of technology analyst approach as to what's going on with Bitcoin. And I started producing these reports twice a year about the mining industry and comparing that to supercomputing, because Bitcoin is the world's largest decentralized supercomputer, all working, cooperatively on the same problem, right? Co-opetition, as they say. And, I looked at trying to analyze things in terms of the block calendar rather than the usual calendar time to see how those would fit. So I was doing some sort of modeling, but it wasn't as serious as what happened, after coming onto the power law. What made me a maximalist was living through the forking wars, really, in 2017.
Yeah, and now we're here. And so we are in 2026. It is a $1.4 trillion or so asset. And over the time that you've been in Bitcoin, has it surprised you, its growth, or having known the power law for some time now, does this seem, are we on track?
Well, in broad terms, we're on track. We're obviously a little bit low relative to the power law projection. But the important thing is that the power law index has been stable for a decade now. Mm-hmm. So it took a while to lock it in. It's a system that was developing, and it had, you have a young child, and those are the most dangerous years, but also the high growth years, and they're volatile, from the growth perspective. And it took Bitcoin about 7 years to kind of lock in and stabilize. And it had this nature from the beginning because of the way it was designed. But it wasn't absolutely certain that it would develop in that way. And fortunately for all of us who are in it, it did. It locked in, and it's been a stable, continuous scale invariant asset that manifests a power law, but also has these discrete scale invariant bubbles and troughs along the way, and I'll talk about that and show some slides on that.
And when we talk about the power law,
was I surprised?
Oh yeah, please.
Was I surprised? I mean, no. I mean, I think once I saw the power law, it just clicked because of the physics background. If you put it on a log-log plot and you see a straight line and you see that it's been going for 10 years from 2009, say price discovery in 2010 until at that time, 2019, you say, wow, that's impressive, because the R squared at 0.95, you just don't find that in finance.
Mm-hmm. And the amazing thing about the power law is that it's not a model you're trying to superimpose on top of Bitcoin, right? It's just an observation of what it's done over time, and it lines up on a log-log chart. It's a straight line. And so that's what makes it what it is, correct?
That's correct. There's a foundation for it. Actually, the foundation itself is multi-layered, and it's the way that a system like this evolves because it is controlled from within. It has all its own rules. And an analogy would be the cell. A cell will take resources in through the cell wall, but then once those are inside the cell wall, the DNA and the RNA decides what happens. So it is self-creating, self-managing, self-regulating inside that environment. For Bitcoin, it takes in energy. It uses that for computation. So, it consumes hash rate, if you will. But once it does that, all the rules are set. The difficulty adjustment determines and provides negative feedback and regulation for the way hash rate gets applied in order to keep the blocks at 10 minutes. If you didn't keep it at 10 minutes, the network would fall apart. You would lose temporal synchronization, because the hash rate has gone up, or the difficulty has gone up from 1 to 100 trillion. That's 14 orders of magnitude, right? So you needed some way to regulate the growth and stabilize it all the way. And there are other stabilization mechanisms and feedback loops. And that's why you end up manifesting a power law. There's a reason for it.
From a scientific perspective, do you think that the difficulty adjustment is one of the most impressive things about Bitcoin that sets it apart from any other network?
It is the most profound design aspect. You could imagine having Bitcoin that even didn't have a finite cap. And it would be better to have a difficulty adjustment and not have a finite cap, and maybe just tapering the supply, than the opposite. It never would have stabilized and gotten off the ground without the difficulty adjustment.
And now we're here. So yes, I'd love to jump into your slides if you'd like to share that with us.
Let's do that. So I've titled this Power Law and More. So here's the agenda. I want to talk about, I'll just mention that we have an absolute monetary standard for the first time in human history. And then I'm going to talk about this terminology, autopoiesis. It's a fairly new word. It's only half a century old as a coined word. Really only Bitcoin manifests this much autopoiesis, certainly in the finance space and in the monetary technology space. And then an introduction to a power law and contrasting that with exponentials. Why power law, the stability of a network. We'll look at the distinction between the power law core and the bubbles. We'll demonstrate that bubbles get smaller, relatively so, not in absolute terms, not in absolute dollar terms, but in percentage terms. And then I'll talk about log periodic timing. And if we have time, we'll have some comparisons with gold. And gold had a very good year in 2025. So what about that? So I like to say that Bitcoin is the first scientifically precise monetary standard in human history. And I would say it's something humanity has been in need of for centuries. We have standard for the meter, for the kilogram, for the second, for mass and for distance and time, and many other standards, that are derived from those, etc., energy standards. We haven't had one for money. And Seifstein, with the Bitcoin standard, really made an argument that, Bitcoin is that kind of sound monetary standard, fundamentally different, certainly from fiat, but it's also fundamentally different from gold as monetary technology. And it's because it's fixed, it's absolutely finite, and it's highly precise. We have 15 digits of precision, given the number of sats per Bitcoin and so forth. And it makes sense as a scientific standard because it's created from energy and math and game theory. And it's independent, it's neutral, it's independent of any particular government. And so it's suitable to be a global standard the way these other standards are.
I wanted to briefly interrupt today's interview to give a big shout out to our lead sponsor, Rhino Bitcoin. Rhino is the all-in-one Bitcoin super app built by Bitcoiners for Bitcoiners. Buy or sell instantly. Send sats anywhere on the Lightning Network. Withdraw straight to cold storage. Even turn sats into gift cards or link to a Casa multisig, all within one sleek interface. And Rhino is just warming up. Soon, you'll pay bills, borrow against your Bitcoin, and save for retirement, all without leaving the app. Download Rhino at rhinobitcoin.com or tap the link in the description below. Use promo code BitcoinNews and Rhino will drop you $10 of free Bitcoin into your account today. Secure your stack with Rhino Bitcoin and enjoy the rest of the video.
Okay, now this term autopoiesis, well, we know what auto is, that's self. Poiesis comes from the Greek. It means creation and production. And the word was introduced in biology around 1972 by a couple of Chilean neurobiologists, but they were both got their PhDs at Harvard. And you can look at the dollar and gold and Bitcoin and see whether they satisfy, the condition here. And what autopoiesis means is self-creation and self-production. So just as I described for the cell a few minutes ago, Bitcoin does all of its own self-management. It has its own rules. It creates its own ledger. It creates its own monetary unit. It has its own security built in. It has its neutrality built in. There's no issuer. There's no foundation. It's open source. Anyone can mint Bitcoin that chooses to do so. And also, it's got this sort of path-dependent memory of the entire blockchain or time chain. And so this, as the system developed, it just kind of closed in on itself. It kind of built the idea of this cell wall or whatever, that everything happens. Yes, you need external resources. You need energy. You need the computation. But within its space, it defines everything. It creates everything and manages itself. So unlike gold, you have to provide the security externally. You have to do assaying and auditing externally. You have to provide the definition of it. So normally this got taken over by states and they said, okay, we're going to mint this coin. It's going to have this fineness and this weight. And that's the only coin that we're going to recognize in the land, right? Will be the national currency. Gold is just atomic element 79. It doesn't reproduce anything or generate anything. It takes humans, externally to turn it into monetary technology as opposed to just jewelry or something used in industrial usage. And the dollar, so it at least it has a very solid core, and the dollar has none of that. Everything's defined externally. The Fed and the Treasury, the policy committees, even the banking loan committees, because most new money creation happens through the commercial banks. And then you get shocks in the system. You have these floating exchange rates, and things are always changing. There was an attempt to tie everything with Bretton Woods in 1944 to the dollar and then have that tied to gold. And that had all collapsed before 3 decades elapsed. And Nixon closed the gold window in 1971. And we had QE, and we had a big explosion in the Fed balance sheet, roughly an order of magnitude, right? It went from less than $1 trillion up to, I don't know what the peak was, 8 trillion or something, but many trillions of dollars. And with COVID, we had another regime break, and the M2 money supply shot up. Checks were issued just freely, right, to people and companies, and the M2 money supply increased 40% within a year or two. So the dollar is highly allopoietic, which is the other end of the spectrum. Gold is somewhat towards the center, but it leans more on the allopoietic side. And Bitcoin is highly autopoietic. All the rules are defined within the system. And it's that allows it eventually to express scale invariance as a power law.
And one question on that. So, outside of biology, are there any other systems or networks that express this autopoietic nature?
Well, the internet, to some degree, not to the same degree as Bitcoin, because again, the rules and the financing and the hubs for the internet are all external. The protocols, provide a foundation. And so there's some of that, but it's not as complete. But there are also things in astrophysics. The best example of something that's highly autopoietic is our sun. It takes care of itself, right? It collapses under gravity. It heats up the core until the core reaches more than 10 million degrees Kelvin. And right now it's 15 million degrees in the core. And it initiates fusion, thermonuclear fusion of hydrogen to helium. And then it's self-maintaining, and it has a lifetime of 10 billion years. So it's an example of a highly autopoietic, self-maintaining system. And as it consumes material, fuel in the core, the reaction rate would slow down a little bit. Then there'd be less pressure, And then the gravity of all the surrounding layers and the core's self-gravity would cause some compression that pushes up the density, pushes up the temperature, and then that speeds up the reaction. And it's metastable over a very long period of time, but it's all self-regulating. Eventually you run out of fuel and it breaks down, but.
No, it's a beautiful example.
Yeah. Okay. Exponentials and power laws. So I've got two graphs here. One is log linear, the other is log log. And you can plot the same curves. These are the same curves, but they're just plotted in different ways, So on the left, it's log linear. And an exponential just grows a certain amount each year. You can think of compound annual growth. That's exponential growth. And it has a characteristic time scale. You can think of that as the time scale for it to double. So if you think about the money supply of the U.S., M2, it doubles roughly every decade. That's 7% compounded growth. Formally, you put it into something that's an exponential with time over some time scale. And, but it could be 2 to some power. So normally you write it, logarithm base E. And then it's a straight line. And you can do log 10, which is what this one is. So this is log 10 linear. So in this particular case, we can imagine I've got Bitcoin on the x-axis, the age, 5, 10, 15, 20 years. And then I've got the price that starts down, at a penny and $1. And here it goes up to eventually $1 million and more than $1 million. And the power law has on this plot a curve shape, log linear. Now there's something called a power law index, but there's not a characteristic time scale. So that's the difference. With the power law, you have a zero, you have an origin that's well defined, but then it's kind of scale invariant with respect to time. You double the time, and then you're going to get a certain growth that's going to depend on that power law index. So it's not going to be flat in this representation, but it also means that it's more stable because exponentials run away and they're therefore unstable. And we know that exponentials in physics govern decay. And we know that in financial series, we see exponential bubbles all the time, but they eventually collapse. NVIDIA is a good example. It had 10 years where it grew at a compound rate of 69%, but it's really physically impossible for it to do that the next decade, because if you did that, it would grow from 5 trillion market cap to 500 trillion market cap, and that's half of all global wealth. So that's not going to happen. The exponential would have to slow down to some slower growth rate. Now, if you put it onto a log-log plot, which is the right-hand chart, we've got the same kind of y-axis for the price scale, but the time scale now becomes logarithmic. So here, the big hash lines are at 1, 10, and 100 years. And so there, the power law is a straight line in log-log space, and the slope of that straight line tells you what the power law index is. Gravity is a square law, but it's an inverse square law. But you imagine you get closer and closer to the sun, the gravity is going to go up. If you cut your distance by a factor of 2, the gravity is going to increase in strength by a factor of 4. If you cut your distance again, it's going to increase again another factor of 4. So that's the way power laws scale. The exponential flies away in this sort of representation. So sometimes it's slower, sometimes it's faster. If you look for shorter periods of time, you can see that they're tangent to each other in either representation. So sometimes you might mistake a series and think it's exponential when it's power law, or vice versa, if you don't have a long enough logarithmic span of time to make that evaluation. And in this case, both have the same compound annual growth rate where they touch. They both pass through the $63,000 price point. I made this sometime last year. But they're very different in terms of their long-term behavior. This is a log-log chart, and this is a log-log candle chart. I have never seen a log-log candle chart until 2 weeks ago when I decided I should make one. So here the candles have different durations. Normally you're used to seeing a candle chart where each candle is a day or a week or a month or even a year. These candles each have different durations. So we have the log of Bitcoin price on the y-axis in dollars, and that's, ranging up to 5 because it's log 10, so that's $100,000 at 5, 10 to the 5th. But along the x-axis, we have the log 10 of age in years. So if it's 1.0, that's age 10. If it's 0.5, that's age 3, and so forth. And so it's equal amounts of logarithmic time. And that means the candles are longer and longer duration as you go, from lower left to upper right. In fact, the first candle has duration of only 0.37 years. And the final candle, I think there are 11 here, has duration of 3.7 years. So each candle is 26% longer in calendar time than the previous one because they're spaced by 0.1 in log 10, and 10 to the 0.1 is 1.26. Well, you only need 11 candles to clearly demonstrate a power law. And the slope of this is 5.8, which is just what you get from using a lot more data and then running regressions through it. And I show two regression lines here. One is OLS, that's ordinary least squares, and the other is the quantile regression median. And they have, somewhat different slopes as we find, but they both run through the candles very nicely. So straight on a log is a power law, and you don't need a lot of data to demonstrate it as long as you have a long enough span of time.
And that slope, 5.8, that's the magic number, right, for Bitcoin power law?
Correct. And you can see that by looking on the y-axis, the top is at 5 and the bottom is -1, so that's 6. And then you subtract the two ends on the x-axis, you have 1.2 and your 0.2. So that's a range of 1, right? So it's about 6 to 1. Yeah, so you can see the slope just by looking at the axes, that it's nearly 6. So you can do this at home. Pick any day during the year and ask, what was the Bitcoin price on that day? And this was mid-April. And so, the last data point was in 2025, but I have the prices. I forget which mid-April date it was, but call it the 15th, say. So it's $5 in 2012, 118 in 2013, and so forth. How many prices is that? A dozen, 13 prices, 14 prices. Then you can run a regression. And when you plot it on a log chart, yeah, you see some noise, there's some structure. But the best fit, ordinary least squares fit, is a power law with an index, a slope of 5.67, which, is in close agreement to the one we saw in the last one. And it's in very close agreement to what we typically see with ordinary least squares. And the R squared, which is the goodness of fit, despite the, you can see some of the bubble structure going on here, is 0.94, which is the square of the correlation coefficient. So it's very good fit.
How rare is an R squared of 0.94 in statistics?
In financial series, you never see it. I mean, it would have to be something that's really locked in. And, it'd be interesting to ask. I know if you take gold and you try and fit a power law to it, the R squared is like 0.28. And if you take the S&P and those kinds of series, you'll get similar low numbers. If you fit them into exponentials, you'll get higher R squared, but normally those are less than 1/2. Seeing something above 0.9 is really unusual.
Yeah, and that's what makes a scientist like you open their eyes when they see these numbers come together, right? I mean, it's pretty astounding.
Right. It's compelling.
Yes.
Okay, in fact, I mentioned NVIDIA, and here's NVIDIA, but this is not a log plot. This is a log linear plot. So we're seeing an exponential because it's straight on a log linear plot. And this spans 10 years. It goes from, I think this is 2014 through 2024. That's what the numbers are there. So it's the year after 2000. And you can see it fits pretty well. And actually, if you look at the confidence intervals, those are shown with the green lines show that where you contain 95% of the points. So it obviously has some noise. I don't know what the R squared was for this, but overall it's a good fit, and it's 69% compounded annual growth. Now, if you look at the decade prior to that, it wasn't anything like that at all. It was less than 10% annual growth for a long, long time. So it took a while before, NVIDIA took off like this. It was pretty flat until you got to 2014. It grew at 69% compounded. If you extended it another decade, it would have to go to 900 trillion market cap. So exponentials are unstable. This, trees don't grow to the sky applies in the case of exponentials. With power laws, you have a much longer runway. And we see many power laws in nature that extend over many, many orders of magnitude. This is Bitcoin, and this is looking at it very crudely, where all I did was take the average return per epoch. So before the first halving, before the second, third, and fourth halving. And I don't have for the fifth epoch, we're only halfway through, not yet halfway through. But the orange line is the average monthly return, and that dropped from 30% on average to about 7% on average in the previous epoch up until the April 2024 halving. And then the blue line is the volatility, and that came down in a similar fashion. It dropped from extremely high to something like 25% on a monthly basis, and 45-50% on an annual basis. If it had been exponential, both of those lines should be straight, and they're really far from that. So this is one of the simplest ways to show that Bitcoin is not exponential. And in fact, these lines are consistent with power law behavior. Okay, here's a detailed analysis that has the full history. These are weekly data points, and both ordinary least squares regression and quantile regression are shown here. The power law is very simple. It has two parameters. It has a scaling parameter, in this case, call it C, and then T for time, and time has to be set to 0, January 3rd, 2009. And so that's the age of Bitcoin, and then raised to some power. So you're used to squares and cubes. Well, this is a higher power. This is a power that's almost 6. And so K is that power law index or slope. And the value you get depends on whether you use the ordinary least squares, you get 5.68, or you use the median for quantile regression, you get 5.87. So they're somewhat different. But those two lines, which are the blue line and the red line, are converging toward each other as time goes on. And the other lines are quantile regression, which basically says that I'm going to put 10% of the data below the line and 90% above, or 10% above and 90% below, etc. So I show 5 of those, and they sort of look like a comb converging as well. And that already tells you that the bubbles are coming down in relative terms, that their volatility for the bubble side is decreasing. And growth for the power. Yes, go ahead.
In the start date, you use January 3rd, 2009, even though there was no price. Does that not play a factor in doing these regressions?
No, it had some value. It just didn't have price discovery, right? So price discovery happened slowly over the next year and a half, but it was not valueless.
Yeah.
It had potential value. And so it, certainly from a physics standpoint, that's the right place to start.
Understood.
And so we take issue with people who try to arbitrarily put it somewhere else. Because it really comes out of the growth of the network, and the network started growing as soon as blocks started manufacturing. Now, if you have that power law, you can project what the annual growth is, and it's this equation 1 plus 1 over the age raised to the power k minus 1. And right now that tells you 40% growth year over year. But that does slow down with time. And to first order, it's just k over t. It's just, to first order, it's the power law slope divided by the age. But there is a second order term that needs to be considered to be more accurate. That thing has what's called a Taylor series expansion. And if we apply that growth, then by the end of this year, we'd expect $160,000 if we're at right on the power law trend. You can vary in price a lot. You can vary a factor of 2 or more on the downside, and you can vary a factor of 2 or 3 or potentially more on the upside. Yeah, I think that's about it. Right now, we should be a little above 120,000 if we were on trend. So we're below that by about 50%. Oh, the other thing is, if you want to know, the other thing you can see right here is you can see that the price went up by a factor of over 1 million as the age went up 10 times. And so that tells you it's around 6, right, for the exponent. Or you can just look at this y-axis as we did before, that we've got 6 orders of magnitude on the y-axis, but we've only got 1 order of magnitude on the x-axis. So a very steep power law.
Mm-hmm.
So why a power law model? Nature loves power laws. There are 4 fundamental forces of nature. Gravity and electromagnetism are both 1 over r squared laws. So the closer you get, the attraction gets stronger by a factor of 4 if you have the distance between 2 charges or between a test body and the attracting body. The strong nuclear force has power law component, but it also has a very stiff spring component, but it does have a power law component. And even the decay force, the weak nuclear force that governs decay, has power law terms as well as exponential terms in it. And you find power laws out in nature, not just in physics, but you find them in biochemistry, in areas like the metabolic scaling. And there's a power law, which is the 3/4 power, which is quite well known. If you look at our metabolic rate relative to elephants and relative to mice, you could put all of those on a power law in terms of your metabolism relative to your mass. And that's a 3/4 power. Gene regulation, protein interaction networks, evolutionary genomics, and the links of proteins and so forth. There are quite a few. But it's also found in socioeconomic distributions, such as income and wealth in cities. Very famously, cities have efficiencies of scale, such that their infrastructure is sublinear with the population, but their output in terms of income, wealth, consumption, even crime rates, both the good and the bad, is faster than linear. And the net result is a 4/3 power law of efficiency of the outputs relative to the input. And it's certainly true of communication networks. And the famous one here is Metcalfe's law. It says that the value of a communications network, or it was applied to the internet by Metcalfe, is something like the square of the number of nodes or users in the network. Here's another example of a socioeconomic power law. Actually, Giovanni just posted this one today. So what we have on the y-axis is the per capita GDP. And we've got, dozens and dozens of countries represented on this plot, which is also a log-log chart. And we've got energy use per capita in gigajoules on the x-axis. And you can see that that spans 3 orders of magnitude from 1 to 1,000. And you can see that the GDP per capita spans 3 orders of magnitude, but mostly 2 orders of magnitude. So the range of GDP per capita goes up about 2 orders of magnitude, while the energy use per capita goes up by 3 orders of magnitude. So that's a power law where GDP per person goes as energy per person raised to the 2/3 power. I actually submitted this chart to chat and asked, what power law do you see here? And it said 0.69. And, they span over time, but the power law continues as time moves on. And you can see the highest use is in North America and Europe as expected. And then as you get to more recent years, Asia would move up. Mm-hmm. So we see this in cities. We see this, in the tails of stock returns, but not in the overall stock returns.
One question for you is, why do you think some people have such a hard time seeing the power law model in Bitcoin? They actually throw up their hands and say, no, this can't be it, when you're just observing how the network has played out over the last 15 years.
Mm-hmm. People are generally not used to thinking logarithmically. People think linearly, and they think in terms of compound growth. I mean, everything that people do in finance is annual return based, right? So people just come with this attitude that stocks pay 9 or 10% in the long run, and if it's NASDAQ and tech, it's going to be in the double digits, 15%. And if I was clever enough to invest in the Magnificent Seven, then I got higher return. But they think in compound returns. For all of finance, it's all modeled that way in terms of normal and log normal distributions and compound growth. And when they go to analyze Bitcoin, all of the finance people use those same assumptions, and they don't even realize they're using those same assumptions, because they look at the residuals and they assume log normal, and they assume residuals where I'm just taking the percentage each time. And you shouldn't do that. What you should do if you're going to look at residuals is first notice that there's a power law, run the power law through, subtract that out, and then look at the residuals. But the mindset is always about compound annual growth. And that's because, we live in we've lived in that kind of economy for all of our life.
Yeah,
I don't know if that's the satisfactory answer or not, but people just aren't used to, if they don't have the physics background or some engineering background or a certain kind of mathematical background, they're just not used to looking at things in this way. Mm-hmm. But Metcalfe was a technologist, in the network hardware space, right? Ethernet and so forth. And he did notice that the value of a network goes as n squared. And the point is that the number of connections goes as n squared. So if the network is small, and there are just 3 of us on the network, well, each person can talk to 2 others. But if you add 1, then each person can talk to 1 more person than before. So it goes as n times n minus 1 over 2, which is an n squared kind of growth. Now, in reality, it may be a little flatter than that because not everybody wants to talk to every other person, but you're getting very substantial scaling, superlinear scaling benefit as these communication and social networks grow. And you can observe that the wallets grew as the cube of the age. So time cubed, age cubed. And then you say, okay, the value of the network goes as n squared, and the n is growing as age cubed. So you're getting cube squared, and that gives you t to the 6. And in practice, we observe a little bit less than that because normally the network exponent is somewhere like 1.6 to 2, and Giovanni's measured it at 1.8, and actually measured the the wallet growth slightly higher than 3. The growth in the number of wallets gets confounded as we've moved to ETFs and treasury companies because they're custodians for many users. But I've found that their holdings have grown as the 4th power of age. So it's the differential there is also cubed, so it's similar.
Hmm.
So Bitcoin's price is really a macro variable that emerges from a technology network that has network structure. And as the network grows, you get some preferential attachment. And you've got this sort of scale-free backbone, which is the base for power law. But when people attach to the network, some are small, some are big, right? Some of those are exchanges, some of those are balances from ETFs. And those fat nodes get more attachment. And when you have a network with preferential attachment, it tends to stabilize it, but also move it from exponential growth towards power law growth. You have monetary transformation that goes on, and that leads to multiplicative price amplification. And multiplicative means adding in logarithmic space, so that's power law. And the hard cap and the declining float is another constraint. And then you get reflexivity. And it turns out that the bubbles, happen, but then when they collapse, you come back to power law behavior. So the bubbles are not power law. They're this kind of exponential and super exponential behavior, but their collapse is also exponential down. And all of these things interacting contribute scaling. And the network structure and the reflexivity are two of the most important ones. Now you can analyze the volatility separately. Yes.
Bubbles just in general. Is this something that we see in power laws, in other power law growth? Bubbles in general, like do they happen, or is this a unique Bitcoin phenomenon that they happen so much?
You see it in networks. And you can think about how the rail system was built out, right? And you can think about how the electric grid was built out and the initial telephone system. So there were certainly bubbles in those, right? I mean, the 1920s were all about bubble and telephone system, yeah?
Yeah.
So it happens in technology networks, and Bitcoin is a monetary technology network. And you see it in, I can't speak to the the biology networks. I don't know enough about those, but you certainly see it in the way cities grow, and those also adhere to this kind of, their networks, their meta networks. A city is a bunch of utility networks and a bunch of output networks. You've got your transportation network, and there are multiple networks within that. You've got your city government network, and there are multiple there. You have the police, you have the fire, and so forth. You have all your utility networks, your power. And all those things scale, providing you more efficiency because it's about a 0.85 growth in cost relative to your population. Because cities are dense, right? And things can be more efficient. Now you can separate out the core behavior and the bubble behavior, and what you find is that the volatility hasn't changed that much in the core. So the green line is the core, and the rolling 4-year standard deviation is like 20%. And that's not the case for the bubbles. They started out, at age 4 having about 100% volatility, and now dropping down to something below 40% for just the core part. And the total volatility would be the combination of the two of these. It would be the square root of the sum of the squares, roughly. And that puts you up in the sort of 45% space that commonly you will see for Bitcoin volatility. And this decrease of the bubble volatility is a reciprocal fit. So it's dropped as 1 over the age. Okay, and now this is how we look at the residuals. We run a regression line through. So this is a a log linear plot, so it's curved. The orange line is the power law trend. In this case, I've used a QR median for that. And then I ran a kind of bubble finder and said, if we're above 0.2 in log 10 price, which turns out to be a factor of about 1.6, then we have a bubble. And then we draw these triangles, and the triangle height and width is showing the energy in the bubble. And there are four major ones. We're familiar with those in 2011, 2013, 2017, 2021. And then there are a bunch of smaller ones that you can barely see on the chart, in the upper chart. And then the lower chart just subtracts out that trend. So it's the same data, it's the same fit with these triangles, but the trend has been subtracted out, and we're only looking at the residuals in log 10 price space. And you can see that those have come down in intensity. And you can also see that there's been some change in the duration. So between the first two was 2.5 years. And between the next two was 4 years. And then people often say between 2017 and 2021, it was 4 years. Actually, that was a double bubble. And the left shoulder was bigger in residual terms, the earlier of the two. And so that was 3.3 years, but then if you look at the right shoulder, it's like 4 years. And we've had no big bubbles since we've had no excursion above the bubble threshold, which here I set at 0.2 in log 10 terms, which is a factor of 1.58 above the trend. We've had no excursion above that since mid-2022, and now we've had, excursion down below, and we're down near the red line now.
And that's why retail hasn't come back. They need to be above that.
Yeah, that's why retail hasn't. Yeah, that's right. Sornet did an interesting study. He's got this model for log periodic behavior bubbles, which is different from the power law. It's more shorter and intermediate term, where you look at an individual bubble and you look at the waves and you see how they get closer and closer to each other. He started out as a geophysicist, so he was analyzing earthquakes and avalanches, and you see that in those phenomena. But he's applied it in finance and in Bitcoin in particular. And he noticed also in a separate study that if you divide into the longest term holders and the intermediate and the short term holders, the lower two always buy at the wrong time and sell at the wrong time. They're the dumb money. And the long-term hodlers will trim their positions a little bit when prices get very high, and then they'll buy back in, when prices are in the winter or trough phase. This is the same chart before, but this is now a Fourier transform frequency analysis of when these, how the whole thing behaves, but what are the natural frequencies? And there's a natural frequency that is spaced in log time, and it has this value. It's measured with this parameter we call lambda, which is a logarithmic wavelength, if you will, and it turns out to be 2.07. You can do a different kind of analysis called wavelets that's used in signal processing, and you identify multiple wavelets, but they're all in the range of 2.0 to 2.1, so they're seeing really the same phenomena. And so if you apply that, then you get these red vertical lines at age 2.4, 4.9, and 8.9, and you can see they exactly hit the peaks. And so those are the first three peaks. Normally people, when they talk about Fourier cycle, they ignore the 2011 peak, which was quite substantial. It was one of the most powerful bubbles. So it deserves to be part of the analysis. There's no red line with the 2021. So the next peak would be out at age 18.4. Now, I did this first in Bitcoin gold, and that's what I'm showing here. Bitcoin measured in gold ounces, the residuals. If you do it in the dollar, you get the same answer. You get 18.5. This does not take phase into account, which is another aspect. Phase stretches things out a bit more in time, but let's not muddy the waters right now with that. This is the fundamental rhythm, which is a logarithmic time cycle. So how do you explain 2021? That's a harmonic. So the blue lines are the first harmonics, and they happen in between, but actually logarithmically in between, or you can think of them as being the geometric mean of the two ages of the peaks on either side. And so they happen at 3.4 and 6.6 years and 12.8 years. And the last one lines up very well with the 2021 second peak. The first two don't hit anything very interesting. There's also a subharmonic, which is the green line. There's only one of these because that's a much slower rhythm or wave. And that does line up with something that was trying to be a bubble in 2019, but didn't get as far as the others. And that it didn't get as far because it didn't have the support from the fundamental. The fundamental was in a down phase, and so was the first harmonic. Again, I've seen this in the dollar, and it gives us the same kind of answer. So just based on this, without considering phase, you'd say mid-2027 would be the next major bubble. The phase consideration pushes that out a bit into 2028.
And
you can analyze the troughs. Yeah, question?
did you get your 2027 number last year when we were expecting a blow off top, or most of the market was?
I found this at the end of November. That's when I realized all of this. And I'd spent all of 2025 worrying about what's going on with bubbles. Are we going to have a bubbles? And doing the analysis to separate the core and the bubble and how those were behaving. And it just kind of, a spark went off that, look, we have a power law asset, which is continuous scale invariance. And it should manifest some discrete scale invariance, which is basically when external forces interact with continuous scale invariance and cause this kind of disruption, if you will. And it turns out the bubbles have both an intrinsic component or endogenous behavior and also external behavior. And they're roughly equal in strength. If you do an analysis with the fundamental, two higher harmonics and one subharmonic, you can explain about 42% of the movement. You get an R squared of 40.42. And so the rest is due to stochastic effects and macro effects and regulations and herding and leverage, everything that, we talk about influencing the market. And the other thing that's going on is that as Bitcoin's price goes up, and goes up by orders of magnitude, which it's done, many orders of magnitude, you attract higher and higher tiers of capital. You did not attract sovereign wealth funds in the first 2 or 3 years, right? You did not attract hedge funds. First you had cyberpunks, and then you had, retail and the first exchanges, and of course a lot of fraud in some of those early exchanges and little regulation. And then you had more regulation and better established exchanges. And then you start getting hedge funds and sovereign wealth funds and higher capital tiers. So as you get these higher tiers and they enter in, they provide some forcing function, and they can cause bubble behavior, or if they stop growing, you can have an end to that. And then you get herding behavior associated with that as people pile in as they see the rising price. And that initiates discrete scale invariance. And so you expect to see log periodic behavior for bubbles. And also, to grow an order of magnitude in market cap takes longer and longer, right? Because on a power law, the returns do slow down with time. So to get to that next tier takes longer. So to the extent that the next tier is influencing the timing of these, you'd expect that to stretch out. And I recently analyzed the troughs. I've got an article on this that I put up on Substack. There are also articles on the other stuff up on Substack. And you get basically the same result. Here, the troughs are shown in blue. The bubbles are shaded green. And you get some smaller troughs, and then I clustered them together into the main overall trough for that cycle, if you will. And so you've got 4 big ones, and then you have one that kind of touched down in early 2020 and didn't quite make it. But you can do a fit to the timing, and you get a lambda that's similar, 2.01, and the individual ones are clustered around 2. So the Fourier analysis, the peak timings say 2.07, the trough timings say 2.01, so they're essentially confirming the same behavior. And also the peaks lose energy, but apparently the troughs do not, which is concordant with what I showed you before about the separation between the core and the bubble volatility behavior. This is the math. It's a little bit complicated. You fit a 5-parameter equation, but what you care about most to understand what's going on is this cosine term, and it has 2 terms in there, this omega and phi. And so you've got these oscillations, but because it's logarithmic, this lambda parameter its log is related to 1 over the angular frequency, omega. And so if lambda is 2, each interval is twice as long. And in our case, it's 2.07, so it's a little bit higher. This phi is the phase shift, and that does push it out in time a little bit. So that's how we get 2028. If we compare the log periodic and Fourier cycles, 2011, the Fourier model ignores that. The log periodic model fits it. They both fit 2013, 2017. They both fit 2021, but log periodic says it's the first harmonic. And that, to some extent, explains the fact that it's weaker, and it's also got this double bubble structure. It's not as well formed, if you will. 2025, you don't expect one, and the Fourier model failed there because it would have predicted one. We have a peak, but it was not a bubble peak. It was just a little bit above the expected trend, only about $10,000 or so. And log periodic, you did not expect a fundamental or a first harmonic bubble, so that's correct. And 2027 or 2028, we expect to see one, and so that would be, maybe we can confirm by then. But the Fourier model was right 3 times and wrong 2 times. And also the RMS error in the positioning is over a year, 1.2 years, whereas the error in the timing is only about half a year in the case of the log periodic. Okay, Bitcoin versus gold. So when the gold bugs give you grief, just show them this and remind them that the Bitcoin price has gone up since 2011, beginning of 2011, by a factor of 100,000. But the gold price has only gone up by roughly a factor of 3 or so. And in fact, much of the time it was going down or flat. Obviously, it's been on this very nice exponential since the beginning of 2024. But we also know that's less stable than a power law. So we would expect that to slow. In fact, you can apply the log periodic power law Sornet kind of models and kind of make estimates of how far that could go. The correlation between Bitcoin and gold is just all over the map. And that's what the other chart shows. Sometimes it's positive, sometimes it's negative. This is rolling 52-week correlations of the log of Bitcoin movement and the log of gold movement. And they just don't persist for very long in phase. Although recently they were positively correlated up until early 2025, and Bitcoin lost its correlation to gold last year.
But because Bitcoin is a power law and gold is not, Bitcoin should go up theoretically forever against gold. correct?
Correct. In fact, the power law relationship is 5.3.
Hmm.
So it's not quite as steep as the 5.7 that you get against the dollar, but it is quite steep. It's over 5.
And so
In fact,
if
here it is on this chart.
okay, cool. And I mean, so if Bitcoin does go up against gold forever, I mean, that is what demonetization is essentially, correct?
Yeah, I mean, gold is already theoretically demonetized. It's virtually monetized because the central banks don't let go of it. And we know that central banks in Asia and China and India and Russia, keep adding to their gold reserves. So it could because they're looking for alternative or defense against the dollar dominance. So it's virtually there as an ultimate asset, even settlement asset in some cases. But Bitcoin will eventually displace it, and you can project this and say, well, sometime next decade, it has to go from 1.4 trillion to, by the time gold grows, maybe 40 trillion, which would be 2 million, maybe $3 million price point. Basically, it has to approach gold. In gold terms, it has to approach one good delivery bar. Bitcoin has to be close to 400 ounces, which is a good delivery bar in gold terms. And right now, it should be more like 40 or 50 on trend, but in fact, it's 14 ounces. The text here is a little bit old when it says 20 ounces. Today, it's about 14 ounces. And we've fallen below the quantile regression 0.1 line, so maybe the power law softened a bit. But if you look at the inset lower chart, it's not unlike things that have happened in the past, and Bitcoin bounced back from those. And so the expectation is we go through 2026 into 2027, and we expect a new fundamental kind of bubble or wave behavior, then, we should reverse. Time will tell.
Time will tell.
But it's a strong power law. Yeah.
Peter Schiff will eat his words soon enough. Soon enough.
Well, Peter Schiff will never eat his words. It's very useful for us to have Peter around.
It is. Keeps us humble. Keeps us humble.
Yes. No, well, we love having fun with Peter. Okay. Peter had a good year in 2025. I think not so much in 2026. So thank you.
Cheers. No, that was amazing. There's so much to Bitcoin, so much more than meets the eye. And I guess as a final question for you, do you find Bitcoin to be as deep of a subject to study as the stars?
Well, I find that it's unbounded in terms of study. So it's that in common. The universe has everything, so it's a little hard to say, that it's quite. We've got stars, we've got galaxies, we've got clusters of galaxies, which was my field. We've got all of cosmology, which I did some work in. We've got quasars, we've got pulsars, neutron stars, black holes. So we've got a lot. But there are some interesting analogies between some things in astrophysics and Bitcoin. And so we like to make those when we can. This star analogy, the sun analogy, those, that autopoietic nature of those being enduring long-term things. People often make the black hole analogy. Bitcoin sucks in capital and it doesn't leave in the long term, right? And actually, I've made a cosmological analogy between dark matter and dark energy and ordinary. And in that analogy, I'll just take a couple of minutes to describe that. In the universe, we have the standard Big Bang model, and we found there was not enough matter to reverse the expansion. But we observed that more gravity than we expected. If you look at the edges of galaxies and you look at clusters, you see about 5 times as much in terms of the acceleration at the edge of galaxies. This was first discovered in the 1930s, actually in clusters of galaxies. And we haven't identified what it is. Most people think it's a particle. It could be some departure from gravity at very low accelerations. It's really an unsolved problem. That's called dark matter. Then there's another called dark energy. Einstein had postulated it with the cosmological constant over 100 years ago. It wasn't actually measured and discovered until 1998 when we saw that the expansion is speeding up. And it turns out that's the dominant term. If you have 100% of mass energy density, 68% of it is in this dark energy, and only 5% of it is in ordinary matter, and the second largest amount is in the dark matter. Well, the analogy is that gold is like the ordinary matter, and the dark matter is like fiat. And actually, Bitcoin is like the dark energy, but back when the universe was much younger, when it was not dominant. So we have a very good future ahead of us. Eventually, it will come to dominate, is the way the analogy works. In the same way that dark energy came to dominate only the past 5 or 6 billion years out of the 14 billion years.
Cool. Well, thank you so much for your time today. Where can people learn more about the Scientific Bitcoin Institute and the work you guys have coming in 2026?
Yeah. For right now, follow Giovanni and myself on X. We are in the process of putting together our website, so it will be that once we get that going within a few weeks. We just found the contractor to build that. And you will see, us providing information there. And then we have a weekly Physics of Bitcoin show, and that's live on YouTube and X. And you can find it from my channel or Giovanni's channel. And it happens at Wednesdays at 10 p.m. Eastern Time, 7 p.m. Pacific Time.
Wow. Well, this has been a great lesson. I appreciate your time so very much. And we'll be sure to have you back. And we got to keep an eye on 2027. I think that's a narrative that the community can stand behind right now. Something that will keep us looking forward. That's great.
Yes. 2026 is a year to get back up to the power law trend.
There we go.
That's the first stage. Thanks so much for having me on, Rob. It's been fun.
Cheers. Thanks for making it to the end of the video. If you could drop a like and a share, it would help in our mission to accelerate adoption. If you're looking for more Bitcoin signal, join over 10,000 readers of our newsletter, Bitcoin News Weekly. Every Monday morning, we send out the biggest headlines of Bitcoin to keep you in the know in under 5 minutes. Links below in the description. Then come hang with us live every Monday at 11 a.m. Eastern. We break it all down live on stream with a new guest, and you can add your 2 sats in the chat. See you next week.